with that, let's also connect with the management then at GIC Re, try and decode their earnings fine print. Then we have Ramaswamy Narayanan, who's a CMD at GIC Re, joining us. So first of all, thank you so much for joining us and good morning. The first question that I in fact had for you was about the combined ratios, because you've seen those declining this quarter. And if we read it right, you do have the claims ratio that has also declined. So what's your read through coming in when it comes to both of these ratios, and was it a one-off event that you're looking at? Because from numbers, it does seem like international claims have also gone down.
So no, this is something that we have been working hard towards. I think if you look at my guidances earlier also, I've been saying that from this year onwards, we've started our growth journey, as well as the effort is to bring down the claims ratio and bring down the combined ratio. So that's what we have done this year. I had also given a guidance that, this year, so last year, 31/3/24, we finished with about 4,000 crores of underwriting loss overall. I said this year we will come down below 3,000 crores, and that we've already done in the 9 months already. So I think we are in a good position now. The book that we are writing is quite good. And I think really going forward, we believe this trend will continue and our losses should continue to go down. Our claims ratio should become better and our combined ratio should also become better.
Right. Good morning, sir. This is Shail also joining in the conversation. Also, I wanted to understand what's the way going ahead when you talk about combined ratio, because the pressure was very visible across. Is it going to decline for your company in particular going ahead? Any target for exit in FY26?
So again, for FY25, I had given a guidance. So 24, FY24, we finished with 112, close to 112. And I'd said typically in the first 2 or 3 years, we would bring down the combined ratio by about 2% each year. And then, next 3, 4 years, we'll bring it down by 1% each year. The idea is to go near 100 as much as possible. So with that in mind, we've already reached a combined of 110.4 for this 9 months. And normally our Jan, Feb, March is the best quarter that we have. So I believe that our combined will definitely go below 110 for the FY 25.
All right, and talk to us about the investment income then, because on the other hand, you've seen that also going down. This has also impacted profitability. So what's the kind of roadmap that you have when it comes to both of these? Do you think this is going to be remaining low given the current market situation also, in fact?
So that is the only area where we've kind of underperformed, if I may call it, because normally what happens is our investment income comprises of two areas. One is the interest and dividend income that we get, and second is the profit on sale of securities or profit on sale of equity. So this quarter, the third quarter, we have not been able to book as much as we would normally do because the market has been on a bit of a roller coaster. The overall indices have come down by about 8%. So, I mean, again, the focus for us is not to sell equity just to show profit on the books. We normally sell only if we believe we need to come out of some securities. So, yes, that is why the overall investment income is flat this time. We are looking at how the market would behave in the next couple of months. In case there are any opportunities, we would, of course, sell and book profits. Otherwise, yes, the investment income might more or less be at the same levels as last year. There may not be any growth.
Well, absolutely. The next one that I had, in fact, in terms of the questions is about the premium in the motor segment. Then that has declined. While when you take a look at health premiums, they have in fact gone up sharply. So what are the kind of trends that you're seeing emerge when it comes to both of these segments? How does the loss ratio landscape then look like to you in both of these segments as well?
So health is something that we have very consciously grown. Like I had said in the beginning of the year, retail health is something that normally doesn't come into the reinsurance market because it can be retained by the companies themselves. But then we actively, engaged with a couple of standalone health insurance companies, and we have got to see some good retail health business in our books, and that is where you see the growth. On the motor side, the reduction in the premium is basically from our international side. In the domestic, we continue to be growing decently well. But on the international side, as I had again said earlier, there was one piece of business that we wrote in the US, which was for motor and marine, which we had come out of in the year 2021. And the runoff was going on. So till last year, we could see the premium. From this year, we are not seeing the premium, which means the business is completely off from our books. So that is where the reduction in motor has come from. Overall, the loss ratios and the combined ratios in these books are better because motor and marine, the loss ratios were very high because of this one particular contract. So since that has gone off our books, the loss ratios and combined ratios are looking much better.
All right, and Mr. Narayanan, I also wanted to talk to you about the budget announcement because there's a couple of announcements, in fact, that we should be discussing. The first one, of course, is that the government has allowed 100% FDI investment when it comes to insurance. So that's this particular note that is in focus. Tell us about how you see the impact and what kind of impact on the overall industry, in fact, are you penciling in?
So I think it is positive for the industry because this will hopefully bring in more insurers into this market, and we surely, for a market of our size, we surely need more insurance companies. Though I must say here that when the FDI was raised from 49 to 74, at least in the non-life, I have not seen much traction. There are only a couple of companies which have actually just gone beyond 50. They have not even touched 74. So how this will pan out is something that we have to wait and watch. But it is positive for the industry because more companies coming in would help to increase the penetration levels. Also, we expect niche players to come in because that is where we need that kind of capacity coming in. And for GIC, we look at it positively because more players coming into the market, they would need reinsurance support, and they would look at GIC since we are the only Indian reinsurance company in this market. So we look at it very positive.
All right, like I mentioned, couple of announcements when it comes to your space. Then the government has in fact reduced the tax when it comes to the new regime. All the incentives though for social security in terms of tax saving for health as well as life insurance are still in the old regime. So do you think there's any kind of impact that you're then penciling in that the shift to new regime can be bringing on life or health insurance then?
Well, honestly, I think my take has always been that, insurance should be purchased for protection and not for, tax avoidance. And that's what I keep telling, people as and when I meet them in different conferences and meets, that you shouldn't really be looking for some kind of a tax bait or tax reduction to really look at what kind of protection needs you have, whether it is life or non-life. I think insurance must be bought because there is a risk that you want to mitigate and not because you want to save on tax. So I don't think that should really have any effect at all.
All right, thanks Mr. Narayanan for taking our time and joining us, talking to us about not just your earnings fine print but also the growth roadmap going forward.